It was another strong day for stocks as the S&P 500 closed up by nearly 1%, which doesn't sound like a whole lot, but considering where we were first thing this morning after hearing news from Target, we saw most stocks underwater as the opening bell started, and then we slowly but surely throughout the day saw prices rise, and we actually ended up having 84% of the components in the S&P 500 closing higher here today. So it was actually a pretty constructive day, all things considered. We'll take a look at that, see what it means for our postures where we do have some new developments. We'll also talk about some leadership within the small cap space and continued strength within the energy patch. Then we'll get into our trade application example where I wanted to feature a bear call spread on a stock that is rolling over underneath its falling 30-day moving average. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 7th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and make sure you go down into the description area and locate our email distribution list so that way you can be notified whenever we post these videos. At the bottom of those emails, we also let you know what stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, we have a lot of green on the board here when we're looking at our traditional S&P 500 heat map, but I'm sure there's one stock that's kind of catching your attention, to put it mildly right now, and that is likely Amazon. Yes, this is a glitch in the system. Now remember, I don't work for Thinkorswim. I used to work for TD Ameritrade, which was closely aligned with Thinkorswim, and therefore we still use Thinkorswim here at Market Scholars because of our history with the software, but I have no say as to how these squares are developed here. Otherwise, I would correct this for you in the snap of the fingers if I had the ability to do that. But right now, we're just going to have to remain patient, I suppose, for Thinkorswim to correct this. And in all likelihood, the reason behind it is because Amazon, of course, just did their 20-for-1 stock split here yesterday. And there's something in the calculations of how this heat map is developed that is kind of spitting out inaccurate information here. It is not true that Amazon all of a sudden is 2 or 3 times larger than Microsoft or Apple all of a sudden. That's just simply not the case. So we'll see how long it takes for them to kind of rectify that situation and put Amazon back into a normal size box the way that we saw them last week. Until then, we'll just have to do our best with kind of looking at all of the other kind of smushed up and skewed boxes and rectangles that are out there. And the key takeaway here is that we did have a lot of green here today. It was actually a pretty impressive day, all things considered. For those of you that might have checked in on the market earlier this morning when I posted my 9 at 9, remember that is something that's available for free on the Market Scholars website. It's also something that I post to Twitter every morning, and it's a good way for you a half an hour before the market opens to get a good feel as to which stocks are going to be leading the market to the upside and which stocks are going to be lagging the market to the downside. And this morning, without a doubt, you would have seen Target and a number of other retailers on the negative side of the 9 at 9. In fact, since I'm sharing my desktop here already, let's just have that conversation and come over here under the blog area of our website. You would click on 9 at 9 right there. And remember, that is available to all of you, even if you're not premium subscribers of Market Scholars. There's a few areas of our website that's unlocked to everybody. And so this morning, you would have seen that Target was down 7% and was leading the way to the downside. So it was a pretty ugly morning there for Target, which of course we remember just a handful of weeks ago was one of the worst performers that day as well. I think Target was down like 25% in one day or something along those lines. So it was not a good view or a good look for the company to be down yet again here 7% pre-market this morning. But to their credit, they actually came firing back pretty good. They did close the day lower. As you can see here, I'm hovering my mouse over the TGT ticker symbol. And so they did close the day lower. However, they only closed the normal market session lower by 2.3%. So again, that's a pretty big improvement from being down 7% in the pre-market a half an hour before the opening bell to then actually closing the normal session down only 2%. So it was a pretty epic reversal, I would say, across the entire landscape of the market. Today did not give us those huge, 2 or 3% up move types of days across the index, but just how the day developed, I thought was rather constructive because it was, pretty negative, and there was a sour mood on Wall Street right out of the gate here this morning, and stocks were down across the board, and we just gradually, surely, day by day, or not day by day, but hour by hour throughout the day, saw that more and more of those stocks started turning green until we had the vast majority of them in the green by the end of the day. So as you can see, Apple had a strong day, up nearly 2%, as was the case with Microsoft there. The oil patch, some of you saw me tweeting about both Exxon and Chevron here today. Exxon hit the triple-digit stock price for the first time since 2014. That was the last time it was above $100 per share, and it closed today at 103.37, which is not that far away from its all-time high, which is just a hair under 105. So within, later this week, we could legitimately see ExxonMobil hitting an all-time high. Here just about 10 or 15 minutes ago, before I did this recording, I just posted about Chevron as well. Chevron hit its all-time high back in February. And it was prior to that at its COVID lows. It was at basically a 10-year low in 2020, and then by February of 2022 it was hitting all-time highs. Now that was back when Chevron in February was trading at $138, because I retweeted one of my old tweets from February where I was talking about that. So it was easy for me to kind of compare and contrast. So back in February, when it was breaking the new all-time highs, at that point it was $138. Today it closed at $180. So in other words, up over $40 per share since hitting all-time highs just 4 months ago, back in February. And you can see some of these other very strong performers within the energy and oil world as well. Conoco was up nearly 5% today. EOG was up over 3% today. Marathon Petroleum up nearly 4% today. And Valero was up over 4% today. So some really strong performers there. I also noticed some chatter on Twitter and see the bright green squares here now myself officially in kind of the defense contracting area. Notice that Raytheon is up over 3%. It's a stock that we bought a couple of years ago during that coronavirus wipeout period. It's done pretty well for us in our dividend growth investing class. Speaking of dividends, Lockheed Martin, of course, well known for paying strong dividends over the years. It was up nearly 3% today. Northrop Grumman was up nearly 3% today. Boeing was up over 1%. General Dynamics was up 2.5%. That's another stock that we've purchased in our dividend growth investing class over the years as a dividend aristocrat in that particular case. So you can see that the defense contractors seem to be consistently green here today as well. So all in all, a really strong performance. Weren't a whole lot of negative, consistently negative areas, other than if you want to talk about some of those retailers, right? Going back to the Target effect and kind of how that then leads over to Home Depot and Lowe's and TJX and Ross Stores and the like. But other than that, it was a pretty strong day across the board, and I really liked how it developed from being largely underwater first thing in the morning to being overwhelmingly bullish by the closing bell. Let's go ahead and now bounce on over here to the normal part of the platform. And I wanted to show you here from a market breadth perspective, I've got the S&P 500 pulled up. And you can see here that 420 out of the 500 companies on the S&P 500 were higher here today. That's good for about an 84% hit rate. So anytime we're up and over 80%, it's usually a very consistent, either bullish or bearish day, depending on circumstances. But today, 84% of the components in the S&P 500 closed in the green. So this was another day, just like I think I mentioned the last time I was with you on Thursday, where both the generals and the foot soldiers all advanced towards a common goal in this army here today. Now on over to our normal charts. You can see that the S&P 500 closed just under a 1% move here today. It was up 0.95%. You can see that the Dow Jones was up 0.8%, which was the lowest gainer of these four here today. And remember, that's often the case whenever we have big moves up or big moves down. The Dow tends to have less aggressive movements because it's filled with blue chip companies that don't move around quite as aggressively as more speculative stocks that are in some of the other indices. The NASDAQ was up 0.94%, so nearly matched the S&P 500 almost to the percent, right there neck and neck with each other. And the Russell 2000 was actually today's leader. It was up 1.57%. For those of you that are newer, the Russell 2000 tracks small caps, largely here in the United States. And they've largely been out of favor in recent years, but tell you what, they're starting to firm up a bit more. And, we've seen kind of this back and forth type of behavior here in recent months, but it does kind of seem like the small caps are starting to take that baton once again and kind of establish themselves as a leader of this market. The reason that I say that is, first of all, notice that the intermediate reading on the Russell 2000 is at 60 and rising. So now that we're above the 50th percentile and rising, we would consider this to be a strongly bullish posture using the market forecast technical indicator, right? That's not David and I's opinions. That's just how you interpret or read the indicator itself. And so as you can see, that actually went to a strongly bullish posture yesterday. Notice how this dark green background color is not just starting with today's candle, it started with yesterday's candle. And that does make it different than these other charts up above, which you can see now also have dark green background colors, but they're starting with today's candle. So in other words, the Russell 2000 already had a head start of one day going into a strongly bullish posture there. In addition to that, even if you just eyeball the charts and look at what we've kind of seen here over the last week and a half or so, I would identify the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite as being in neutral trading conditions, right? If you were to look at this candle and then as your starting point right here that I'm circling, and then use this candle as your end point, kind of your bookends there, they are nearly as flat as a board as you could possibly get. And that's the case not just on the S&P 500, but over here on the Dow and down below here on the NASDAQ Composite as well. Now look at the difference on the Russell 2000. Here you can actually see an upward ascent over the last week to week and a half. It's not dramatic, it's you might need to squint if you are looking at this video on your cell phone, especially right now. But if you're on a large screen like I am with my computer monitor, it's relatively easy for me to see that we have more of an upward ascent right now over the past week and a half on the Russell 2000, and I can't really make that claim on the other indices. Now, don't get me wrong, I'm happy to see and to report that the Dow Jones and the the S&P 500 both have strongly bullish market forecast postures, just as the case with the Russell 2000. But if you're going to press me on it, I would say that I like the strength out of the Russell 2000 more than I like the strength out of the other two. And of course that can change. That's the whole point of looking at these charts and doing these videos as often as we do, because things do change. And when they do, then we have to, change our thoughts, and that might change our assumptions, and that will likely change the way that we might trade. So all of that works together. But I just thought I would point that out because that was one thing that did catch my eye here today, is that I do feel like there's a little bit more persistent bullishness out of the small cap Russell 2000 universe than maybe what we'd seen here prior to that for the reasons that I mentioned. So to put a ribbon on it, the S&P 500, Dow Jones Industrial Average, both at strongly bullish postures starting today. Russell 2000, strongly bullish posture starting yesterday. And the NASDAQ Composite still seems to be our laggard. First of all, notice they do not have a strongly bullish posture, right? You don't see that dark green background color on the NASDAQ Composite. So that's one way to identify them being kind of a laggard in this market on a relative basis. But in addition to that, notice that the reading itself at 45, so remember, unless you hear us say otherwise, when we say the market forecast posture, what we are referencing is the green intermediate line. Now, technically, there's postures on all of these lines. And, if we ever talk about the near-term posture or the market sentiment posture or the momentum posture, we'll be sure to, specify that. But if you just hear us say the posture generically speaking, then what we are referencing is the most popular green intermediate line. And if you were to look at the reading in the label right now, it tells us that the NASDAQ Composite's current reading is at 45. And that is lower than what we see with the S&P 500 at 52. It's lower than the Dow Jones Industrial Average at 54, and it's lower than the Russell 2000 at 60. Notice that the Russell has the highest number, the NASDAQ Composite has the lowest number. The Russell 2000 is 2 days into a strongly bullish posture. The NASDAQ Composite still has not accomplished that yet. And maybe they will starting tomorrow. Remember, in order to get to a strongly bullish posture, the NASDAQ would just need to go from 45 to above 50. So that's not all that difficult to do, especially when you've got the momentum on your side. And so if we do have another bullish day tomorrow, it's entirely possible that the NASDAQ will then start flashing that strongly bullish, dark green background color there as well. But do keep in mind this. It's important to recognize that postures are one thing, market trends are another. Remember, there are literally hundreds of technical indicators out there. The market forecast technical indicator is just one of literally hundreds of indicators. At any given moment in time, you could find a bullish indicator and you could find a bearish indicator on the same exact underlying security. That is the nature of technical analysis. There's never a situation where all hundreds of technical indicators are all going to be pointing bullishly or bearishly at the same time, or at least I'm not aware of that. So you have to understand that these things aren't perfect, and a lot of it is in the eye of the beholder. But one thing that keeps nagging in the back of my mind is the fact that despite us having stabilized in the market here over the past week or two, we really have not seen a turnaround in the moving averages yet. Right? It's good that we see the postures pinging back to bullish on the market forecast, but if you look at the 30-day moving averages, they are all still pointed down. Now remember, if you know the color coding system, that's very easy to identify because all of our moving average colors are yellow at this moment in time, and we can clearly see that the price candles are above the moving averages. And so in a case like that, what it's identifying is the moving average is going down, but the price is above the moving average, right? When price is below a falling moving average, like it was back here on the NASDAQ, then it's going to be red. When price is above a rising moving average, like we saw up here with the S&P 500 for a brief time at the end of March, it was green and telling us, that things were stabilizing for a trend at that point a little bit better. Now we know after the fact that did not last that long. But that's the type of behavior you want to see consistently for longer periods of time if you are expecting some sort of a legitimate trend reversal type of a move out of this market at this moment in time. And I'm still a little bit hesitant in my willingness to assume that that is going to be the path of least resistance. My mindset remains that while I'm thankful to see stabilization, I'm thankful to see the relative lack of selling compared to where we were at a couple of months ago. I still am in the mindset that we are not going to be hitting all-time highs in the next month or two. And I could be wrong, and I'll be happy to admit that and report it when it happens, if it happens. But right now, I still remain a bit hesitant, thinking that the selling got too overdone when we were down 7 weeks in a row in the market, which was like the third worst, streak in stock market history. So we were talking about some extreme numbers. Really, the only thing we were waiting for that we didn't get was a huge spike in the VIX. We still saw the VIX up there at relatively high levels, but we never got that big washout type of a day. But if you were to read a lot of the other market statistics around May 20th, there were a number of really, really extreme readings. And it's natural for the market to then kind of revert to the mean after, making like 3 standard deviation types of moves in certain market statistics. So I am glad to see that we have stabilized. I think that is important. And if we are to kind of use this as a constructive area to build from and move towards all-time highs later on this year, then this stabilization is necessary. So it's good to see it here. It's just that personally, I think that with inflation still roaring and with the Federal Reserve not really giving any indication that they're going to be kind of pulling back on their plans to raise interest rates aggressively this year, I just think that we're kind of facing, some tougher times in front of us. And I don't think valuations are overly cheap either. They got cheaper, but if you were to look at something like the Shiller PE ratio, more of a cyclically adjusted PE ratio, the CAPE, you're still talking about some of the highest valuation levels in market history. So it's just not quite as overvalued as where we were a few months ago. So, we just haven't really seen a big flush to the point where I think that we are done with the rough times and that the coast is clear and it's all puppy dogs and rainbows once again. I hope I'm wrong about that. But until then, we'll continue to look at the charts, see what the market tells us each and every day as things go along, and maybe we'll have some positive surprises as time goes forward. But, judging by what we saw from a corporate perspective with Target here today, that didn't really help the storyline at all. How the market responded to that was useful, but the story itself was not all that encouraging if you want us to be in a really strong economy to support the stock market. Let's go ahead and take a look here at our 3 green arrows chart now. And this will be chart 4D for those of you that are premium market scholars that are following along with your own charting package at home. And as you can see here, we do have 3 green arrow signals on all 4 of these charts. When the background colors are this green color here on this chart 4D, it references that idea of 3 green arrows. Now, 3 green arrows is kind of it's a phrase that we used to use at the prior company that David and I used to work for, InvestTools/TD Ameritrade. And the idea there of the 3 green arrows strategy was one that you would implement that signal alongside a trend trading mentality. So it is true that we have 3 green arrows on all 4 of these charts, which again is constructive. I don't want to take it away from the market, credit where credit is due. But if you were to look at these 4 charts in front of you and truthfully ask yourself, do these look like strong trends? Is this a good market to be trend trading in? I think most of you would probably answer no, and that would be my answer largely as well. Now, obviously, there are some areas that have done just fine. We talked about the oil companies already in this session. Had you been trend trading the oil companies like we are in my trend trading class right now, we own 6 different oil companies and or ETFs out of our 25 stock active portfolio. And we're thankful for that because, of course, energy has been one of the only places that has shown consistent trends this year. We've seen other sectors that have kind of come into and out of favor, and it's just been more choppy and not particularly satisfying. But with energy, that's a different story. Energy has been a home run pretty much all year long. So with the exception of energy, we really haven't seen a whole lot to get excited about from a trending perspective, and that makes sense. When you look at these four broad-based index level products in front of us, none of them look particularly attractive from a trend trading perspective, right? They still are really trading below where they were, 3 months ago and 6 months ago and a year ago, right? We see all these labels up above these charts here, and the vast majority of them are red. The only green one we see is on the Dow Jones Industrial Average, where we just happen to have a 1.5% return over the last 3 months. Otherwise, year to date, 6 months, 1 year, on all of the rest of the charts, negative performance across the board. That's generally not a good trend trading environment. Doesn't mean that it can't be a good, value investing environment or dividend growth investing environment. I taught my dividend growth investing class, and for the second straight week, we can claim that we are profitable on a year-to-date basis. And in that class, we keep it very simple. All we do is buy stocks. We don't have hedges. We don't have inverse funds. We don't do any fancy techniques with futures contracts or short selling or anything like that. We're just simply buying dividend stocks, and we are making money on a year-to-date basis. And I would have a feeling that most people who focus on the long side of the market cannot make that claim in a year like 2022. So, there's a handful of places and themes and other trading techniques and investing techniques that might work, but trend trading this year has been awfully difficult outside of the energy complex. And so, yes, it's true, we have 3 green arrows on all 4 of these charts, but am I excited about it? Not particularly. To me, it still feels like we're in kind of a reversion to the mean type of a bounce off an extremely oversold level, and I don't see constructive trends taking shape quite yet on these charts. And again, I hope I'm wrong. Maybe I'll come to you a month or 2 from now and it'll say, yep, it looks like we do have a trend now. And that's okay, right? But, in the meantime, we've got work to do. We're still well below the same levels that we were trading, 3 months ago, 6 months ago, and 1 year ago on most of these markets. And so, yes, happy to see the bounce, but should we get overly exuberant about it? No, I think it's best to kind of keep our cool heads about us and try to remain rational in this market whenever possible. All right, let's go ahead and step aside over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this Market Outlook presentation. On Thursday, I spent a bit of time in that session, that Market Outlook session, showing you the 4 different ways on how to click like on Twitter. And I think I made my point that day that was a one-off, and the only reason I was showing you in that video the 4 different ways is because I recently got asked how to do that by somebody else that was unfamiliar with that. And, I don't plan to do that every time, obviously, because it would just soak up too much of our analysis time. So that was a one-off, and I think I was pretty upfront when I told you that was the case. And the other thing that I would mention is sometimes, people might think that human nature is such that when you ask them to do something, their first instinct is not to do it, right? We all, think of, little kids or what have you. I'm the father of a 7-year-old, so sometimes you tell your kid to do something and you can tell they're trying to, drag their feet or what have you. But we've actually found the opposite here. In fact, David was the one who kind of taught me this back at our old company, as he was already kind of in management back then, and I was still a coach teaching the classes that was just getting on social media. And he said, you know what? If you provide good content and you ask people to click like, they'll do it because they want to help support you. And we've largely found that to be the case. You guys are largely supportive. Sure, there may be a handful of you that when we ask you to click like, you refuse to do it. And the only reason you won't do it is because we asked you to do it. But I would venture to guess that's a reasonably small group of people. Most of you, if you have the ability to click like and we ask you to do it because we're giving you this free content, most of you will, of course, assist us with that. And the one thing I would point out is that when I did that on Thursday and I showed you how the 4 different ways to click like on Twitter, you can see that 132 of you did that. This is actually one of our biggest liked tweets for the Market Outlook videos specifically. Most of you know that we usually get somewhere right around 100. This time we got 132, and again, that's probably one of the biggest liked Market Outlook videos in months or years. And so I think there's a direct correlation there as to why that's the case. On Thursday, I showed all of you how to do it, and while it probably frustrated some of you, I have no doubt that it did because I hear the feedback, you can also see the direct evidence in front of your face that the technique did work. So thank you to the 132 of you who clicked like for us and letting us know that you're thanking us for our work and that you want us to continue these videos as often as possible, even though it does take away about 3 hours of our day, and we're not getting paid to do them, right? We're doing them as a benefit to you guys educationally, and hopefully as a way to kind of get the word out about Market Scholars on a premium level for what we do for the rest of our days there. So thank you to all of you that help us along with that. One other thing I wanted to mention while we're over here, I can see that there's this dividend growth investing post that's kind of listed here under the popular recent posts area. Last week, it might have been Friday, I put that together. Some of you are familiar that I personally am a dividend growth investor, so I always have to chuckle that I'm so heavily involved in this active trading video here of the Market Outlook videos, just how things have shaken out over time. But I personally am a dividend growth investor. That's where my passion is. And so each month I put together a post of all the companies that have grown their dividends or made dividend growth announcements during that month. So that way you can kind of compare and contrast them to other companies that have also announced increases, or compare them to themselves and past increases from previous years and things like that. Now I'm pointing that out because this is another area like the 9 at 9 that I showed you before, which is open to everybody on our website. You do not need to be a premium member of Market Scholars to access that. You do have to be a premium member to access my dividend growth investing classes, but this monthly post that I put together of all the stocks raising their dividends, you do not need to. So if you have friends or family that are interested in dividend investing, feel free to direct them to that. I actually have that pulled up in a separate tab over here, kind of show you what it looks like there. And I did spend some time in my Monday afternoon Options for Long-Term Investors class this week going through my analysis of these dividend announcements and which ones impressed me, which ones I thought were a little bit mediocre, and everything in between. So if you're a premium member of Market Scholars and wanted to hear my analysis on this, then check out the video that I posted on our Trading Rooms calendar for my Options for Long-Term Investors class here yesterday afternoon. Otherwise, feel free to spend some time reviewing that data on your own, as it's open to everybody on our website under that blog area and dividend growth investing. Last but not least, let's talk about that sector selector. This is what I put together for my Monday top-down trend trading class, and I put it together over the weekend. So it is a couple of days stale by this point, but still gives us a pretty good feel if there's any sort of major rotations that we'll want to be aware of from a sector perspective. Now keep in mind, I do use an equal weighted approach when I'm doing these rankings as opposed to a market cap weighted approach. And I'm using 3 different time periods as my inputs. I'm using a 1 month, a 3 month, and a 6 month time period. I'm aggregating them together, but I'm weighting the more recent 1 month time period more heavily than the 6 month time period. So it gives us a good feel. It's not perfect, nothing is, but it gives us generally a good feel as to what rotations we might be seeing within the marketplace. Now, week over week, we didn't really see much in the way of major transitions. In fact, the only ranking changes we saw from the prior week were in the 5-6 slot. The prior week we had healthcare in the 5th slot and industrials in the 6th slot. This week they just flip-flopped. Industrials is in the 5th slot and healthcare fell down to the 6th. So not a whole lot to report there. I did notice that some of those major pharmaceutical companies that were doing so well earlier this year, like Merck and a handful of others that were kind of getting the benefit of that switching into the defensive types of companies, they kind of pulled back the reins a little bit in recent weeks and have given way to more speculative areas as the market itself has caught a bit of the bottom. And so there might be a little bit of that at play right there, but I don't want to make too much of that either. When you're just making a one ranking transition there, it's possible these two were about as close as tied as possible, but one was just like, 3 basis points lower than the other one or something like that. So not a whole lot of change to report, despite what seems to be a pretty aggressive bounce off of the ultimate lows on May 20th for the general stock market. Most of our same trends that we had witnessed going into the 20th remain true today. We are still being led higher by energy stocks and more defensive areas, and some of our more compounding growth areas like communications and consumer discretionary still lagging at the bottom. And if you just looked at today's market activity, that should still spell true, right? We saw Exxon and Chevron crushing it to the upside for the energy stocks today. Who did we see on the downside? Target and Home Depot and TJX and Ross Stores. Those are all consumer discretionary stocks. So even just on a one-day basis, some of those themes are still shining through the same way that we've seen them for weeks and months at this point. All right, let's go ahead and jump back on over here to the platform now. And let's go ahead and take a peek here at some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And this will give us a good sense across a broad spectrum of financial securities where we have strength versus weakness. Now let's get started with one of the big stories of the day. I've already discussed it a couple times in the video, but here you can kind of visualize it even better. Here is oil down below. Now we're using USO as our proxy down below because it allows us to add this label to it. Technically, if you pull up /CL on Thinkorswim, you can also get a feel for what the contracts are, but because the contracts are technically rolling over like every month, I can't actually add a label on there because there's technically a longer ticker symbol than what is visible to you right here, representing the actual contract. So if any of you have ever wondered why do we use USO as opposed to /CL, that's the reason. I like to see that label on there. It's a little bit easier to teach from for a broader audience like we have here on this YouTube video. But it's a good proxy, right? It's an exchange traded product that you yourself could trade if you wanted to take advantage of the trends, and usually does a pretty good job following the commodity that it is supposed to, in this case oil. And you can see that USO did hit yet another high here today. Talked about that last week. It was kind of making its move and then eventually actually put in an overbought cluster signal where yesterday you were down for one day, but we're right back to new highs here all of a sudden. Remember, if you are a premium member of Market Scholars and you have access to this charting package here, and especially this chart 5A or really any of the 12 grid charts, if you right click on them and then go to maximize sell on that submenu, you can see here that you then would see the actual market forecast technical indicator down below. So when you see that red dot on the miniature chart, you can then visually see why that red dot is showing up, because the red, the blue, and the green lines on the market forecast technical indicator are all in the upper reversal zone on the same day. But when you kind of go back to the 12 grid view, the system automatically tries to hide certain things because otherwise all the information would be all scrunched up that you couldn't make heads or tails out of it anyway. So point being, oil remains incredibly strong. Remember, on Thursday, we had a very strong day for the market, and I did this video for you guys at that time as well. And I was talking about the energy sector. And remember, that day, the energy stocks were the only ones that were down. And I said, don't beat up too much on them. They deserve a day off. In other words, just because they had a down day when the rest of the market was up was not a reason to give up on extremely strong trends that exist on the oil stocks. And I don't think many of you would, but I wanted to at least make that point, especially for folks that are newer and they don't know their way around the charts that many of you do. And so anyway, a couple of days later here, I'm glad that I uttered those words because, as I mentioned before, Exxon and Chevron and Conoco and EOG and all those companies were just absolutely crushing it to the upside. And we'll take a look at the energy sector here in just a little bit on our next 12 grid. And just wanted to point out that we'll see very good strength out of that sector today, and it makes sense given the fact that oil itself was breaking to new multi-month highs. Remember, oil is still not back to its old highs from before the great financial crisis of 2007 to 2008 time period, but we have been making multi-year highs ever since then with this most recent move. So it's a good, strong trend that exists still in the oil patch. In terms of other charts that are looking reasonably strong, there are a number of other green charts on the board suggesting that we do have bullish market forecast postures. But to be honest with you, I'm not particularly enthusiastic about really any of the rest. The 10-year Treasury yield looks okay, but it doesn't look nearly as good as oil. Oil looks great. The 10-year Treasury is stabilizing, and it's strong, and it's above a rising moving average, and it has that strongly bullish posture, but we're still well below the highs that we printed on the 10-year Treasury yield back here in the beginning of May. So it just kind of almost feels like it's kind of losing some of its gas here more recently, whereas we're not really getting that sensation out of oil itself. 10-year Treasury yield did close lower here today. It is back below 3%. We had a good conversation about that yesterday in my dividend growth investing class, and then also last Thursday in my question and answer session, talking about the impact of the 10-year Treasury yield and how we think about dividend growth investing. And there is actually an alternative these days, right? The old phrase was the acronym TINA, there is no alternative. Well, bonds are actually a legitimate alternative, once again, if they're yielding 3% or more. And that's approximately where we're at this moment in time. Whether it stays there is anybody's guess, but right now we're just on the underside of that 3% yield level on 10-year Treasuries. And of course, when yields are strong, the inverse of that, the prices of bonds themselves are typically weak. And we do see that playing itself out through the long-term Treasuries chart up here being strongly bearish. Note the dark pink background color there. Now, just like Treasury yields were down today but have a strongly bullish posture, note that long-term Treasuries themselves were up slightly today but still have the strongly bearish kind of longer-term intermediate posture that you have right there. And that makes sense. You look at that chart, it's clearly a downtrending chart, as is the case here for foreign bonds. High-yield bonds were a little bit different. I talked about this maybe a week and a half ago with you guys. It's kind of, pulled in a little bit since that heady time. This is what I'm referencing right there, where we had that 4 or 5 days in a row to the upside on high-yield junk bonds. We have given a pretty big chunk of that back, but you will notice that high-yield bonds remain considerably above their lows from back here in May. Whereas you don't really get the same impression looking at government bonds in the United States or even foreign bonds. And that's a healthy sign for risk-taking, all else being equal. When you have a more speculative, frothy type of market, you want the high-yield junk bonds to be outperforming those other types of securities. So I think that somewhat bodes well for the markets at large as well. It's just that we have had a little bit of a pullback in that over the past week, so maybe the speculative activity is not quite as robust as what we were looking at a week ago. You can also see that Bitcoin had a pretty decent day. Now, Bitcoin has struggled with alongside a lot of other speculative assets here in the last 3 months or so. So it's been due for a bit of a bounce, but it did close up about 6% here today and finds itself right around 31,000. Note that it does have a weekly bullish posture. However, it's not trading above its moving average yet. In fact, it's still trading below a falling moving average, and so still doesn't look like a good trend. However, for those of you that are out there looking for more bang for your buck, maybe you're going to be trying to buy this cheap and sell it a little bit more expensive. Of course, that comes with risk because you don't have the support of an actual trend on that, but maybe you could get away with saying it got a little bit oversold here when it was producing a number of those green dots, those oversold clusters right there. In terms of the top charts, you will see here that we do have green charts, whether we're talking about the U.S. stock market, the foreign developed stock market or the foreign emerging markets stock markets. All three of those charts are strongly bullish intermediate postures according to the market forecast. Not only that, but I would take it a step further and let you know that we have new information to share today. Notice that EFA now has a green moving average tip. And what that means is that price is now above a rising moving average, right? Price has been above the moving average for the last week and a half. But it wasn't until today that the moving average itself started to curl higher. Now the trick will be, let's see if we can make it last for more than a day this time. And I'm only halfway joking there because the last time it gave us a green moving average was right there. You kind of have to squint to see it, but that was back on April 7th, and you only had it for one single day. And so let's hope that we can go at least 2 days this time around. Ideally, we go a longer time, right? I think one theme that a lot of people have been kind of waiting to see if it'll play out or not is, for foreign stocks to start outperforming U.S. stocks. The U.S. has seen the lion's share of the alpha gains over the past decade, and foreign stocks have kind of sat out the rallies in most cases. That's not particularly normal. And so it'll be interesting to see if we can go through a period of time where foreign stocks can start outperforming U.S. stocks. And if that is to happen, it's likely to happen under a weak dollar environment. And you can see down below here, the dollar has been largely weak ever since putting in those back-to-back overbought cluster signals. That actually called the top so far on the US dollar. And you can see the US dollar remains strongly bearish and still trading below its rising 30-day moving average in that particular case. So if we have more wear and tear on the US dollar, there's a pretty decent chance that foreign stocks could actually kick it into high gear and outperform the United States stocks for a period of time. Let's go ahead and take a look at our sectors now. And so this will be chart 5C for those of you following along at home. And let's go ahead and start with energy because we've talked a lot about energy in this presentation thus far. We might as well continue the theme. And here's what I was referencing before. XLE was up 3% here today, a huge day for XLE. And remember, XLE is a little bit peculiar in that it is heavily driven by just two stocks, Chevron and Exxon, because it is a market cap weighted ETF, and those two are by far and away the largest market caps in the energy patch. So when you think about Chevron and Exxon, you think of kind of that integrated oil model that generally is a little bit less volatile, less extreme in its movements. So when you see the energy sector up 3% today and know that it was driven by Chevron and Exxon, that's really saying something. That was a huge candle that it put in here today. And again, going back to my comment on Thursday, right there on that candle that I'm pointing at, remember, on Thursday, it was the only one that was down. And, I urged you not to make too much of that because if you're going to sell just because it was the only one that was down that day, you just missed a massive rally in 2 out of the following 3 days after that, where XLE has gone on to multi-year highs here all of the sudden. So, again, I sound like a broken record, I'm sure of that, but it's important for you to have these takeaways that in 2022, it's energy's world and everybody else is just living in it, right? If you look at these charts, there's only one chart that looks the way that this one does, and it's energy. This is a strong trend that we have in place right here. All the rest of these charts are green, so we're thankful for that. There's been stabilization. We now have either weakly or strongly bullish postures on all the rest of the charts, so we have a clean sweep there from a posture perspective. But if you're honest with yourself and looking at the trends, none of them look particularly enticing. I would say that utilities looks okay, but I still wouldn't go on record saying that utilities looks good for a trending perspective. There may be individual utilities companies. I know a couple of them that were trend trading, like NFG in my Monday class, looks a little bit better right there. We also have SWX, Southwest Gas. It's looking a little bit better. But if you were to look at that group as a whole, I'm not particularly enthusiastic about the trend swing trading prospects there compared to what I see with XLE. XLE looks great. Utilities has stabilized and has bounced, but we're still well below where we were trading back here in April. And that's the second best looking one, right? Let alone how bad some of these other charts look, right? If you look at discretionary, which notice they were the only sector that was down today as a result of the target news that I'd mentioned before. But discretionary, you could kind of get away with saying, you know, watch out. This could actually be more of a bearish type of a look right here, where you've kind of had these oversold cluster signals leading to a dead cat bounce that puts you back up into a resistance area, and now it's starting to look like it's rolling over again. And so maybe that's an area where you can, you know, put on some bearish trades or what have you. But you look at this chart on discretionary and then you compare it to energy over here, and they are night and day difference, even though technically they both have rising intermediate lines, making them both bullish postures according to the market forecast. But that's why we need to use our eyes in addition to knowing the postures to try to determine which charts actually look better for whatever it is that you're hoping to accomplish. So anyway, speaking of bearish trades, let's go ahead and get into our trade application example here for the night. Now this will require a little bit of an explanation, and I'll do my best with it. So let's pull up ticker symbol FMC. This is FMC Corp, and I actually did a bear call spread on this. Now remember, we do these trade application examples, we get the trades done while the stock market is open. And then what we do is we send out the Telegram trade alerts to all of you who are premium members of Market Scholars. Naturally, everybody who's just watching the free YouTube video learns about them at the time they watch the video, either that night or the next day or whatever. So it gives a slight perk and an informational advantage, I guess you could say, to our premium members there. Now, in this particular case, I wouldn't say that necessarily helped them. And the reason I say that is because, wouldn't you know, that I got the trade done a little bit earlier today than I did on Thursday. You'll recall on Thursday I was mentioning how I got the trade done a lot later than I would normally have preferred because I couldn't get my first two choices done. So I kind of had to relent and do a third trade. So I didn't get that one in until like 5 to 10 minutes before the market closed. Today I got this one done about 20 to 25 minutes before the market closed, giving you a little bit more flexibility to consider the trade idea. But this was a day where I wish that was not the case. I wish I could have flip-flop days there. I wish I would have done this trade at the end of the day. And the reason I say that is because if we come over here to the trade tab briefly, you'll see that I placed the trade right around here on the 1 day, 1 minute candle chart. And within like a minute of me placing the trade, wouldn't you know, this sucker just rallied strongly into the close. So I'm already down $25 on this trade. I'm not too thrilled about that. It is what it is. But the reason I'm bringing that up is because it affects our mindset of the trade itself. When I placed the trade about 25 minutes prior to the market close today, when its stock price was lower, you can see it actually closed at the highs of the day, but 20 minutes before the market closed, it was trading lower in this candle range. And at that time, it had a bearish posture. Notice that with that little rally that you got just at the end of the day from about 120 up to 121 or wherever it closed, that $1 move in the last 20 minutes was enough to change this company's posture from being bearish to being bullish. Not by a strong amount, so it could easily slip back into bearish posture tomorrow. You can hardly even see it with the naked eye by looking at the green line itself right here. But in case anybody was wondering about that, I wanted to be sure that I explained that because it can be a little bit confusing if you're saying, well, wait a second, Brandon, you said you're doing a bearish trade here, but it looks like that it's showing us that the posture is bullish. Are you sure that's what you wanted to do? And it wasn't the case, and that is kind of the downside of placing trades on an intraday basis, that your signal may actually change by the closing bell. So today was one of those rare days where that actually did happen. Now, having said that, this is still a chart that kind of gives us more of a bearish type of an impression. And the reason I say that is this was actually a very strongly trending stock for many months until around this time period at the end of April, where we went briefly below the moving average. We tried to pop back above it, and then it rejected it right around the same time you had its earnings announcement come out, and then that stock just plunged day after day after day after day. It ended up going from like 135 all the way down here to 111 in a straight line, right? That happened all in a week and a half. And then we had this little bit of a reversion to the mean move. Now note, you did have an oversold cluster signal. Actually, you had 2 in a row that started off that bottoming process right there. So that was not surprising, right? And it's also not surprising that where it's starting to find resistance is its downward trending 30-day moving average. So I like those types of setups where you had a trend change that took place, you had a reversion to the mean move off of an extreme sell-off, and then it kind of resets the deck and allows you an opportunity to do a bearish trade up here with better pricing, as opposed to doing a bearish trade in the midst of a free fall where your pricing could very well have been worse. So do I wish that I would have waited until just a couple minutes before the market closed today to place this trade? Sure, because I probably wouldn't have placed it. I probably would have done a different trade, but it is what it is. And that's kind of the downside of being a trader, right? These are some of the real life circumstances that all of you deal with as well when you're placing trades at one part of the day and then things change by the end. Today was one of those for me, but we'll keep the trade on and we'll see how we do with it. What I ended up doing was selling the 125, 130 bear call spread. And we got about a 30% return on risk for that. So remember, if you're a premium member, you can always see the strike prices and the execution details and all that in the Telegram note that we send out to you as well. So we're going to add another bearish trade here, just like I did last week, because our portfolio is still chocked full of bullish trades at this moment in time. Because remember, when the stock market was going down for all those months, I was doing bull puts left and right. It seemed like every other time that I was with you, I was showing you selling put trades. All of those were bullish trades that we still have in the portfolio right now. And so we're now getting the benefit of having been brave doing bullish trades while the market was more bearish. And now we're going to maybe kind of test the opposite approach here. While the market has gotten a little bit more bullish lately, I'm going to try to be a little bit more brave and do more bearish trades with the expectation that we're still going to have a lot of chop and slop as we move forward through the summer here. Okay, so that's what I had for you here tonight. Now keep in mind, David is on a little bit more of a sporadic schedule this week, as I believe he's kind of doing some things with basketball camps and his kids and things like that as well. So I'm not exactly sure what his schedule will be with the Market Outlook video. He might be able to do them here or there if he gets a chance, but otherwise he's kind of away from his normal trading station right now. But I will plan on being back with you during my normal slot. Remember, I do the videos on Tuesdays and Thursdays, so I'll be back with you on Thursday. And I'll plan on doing another full-length video like this one as long as our like count on Twitter is up and over 100. If we're below 100, then I'll just give you a quick hitter type of 15-minute video only on the indices with no trade application example. So it allows you guys to have a bit more control and say as to the path moving forward. If you want to support these videos, the easiest way for you to do that is click like for us there on Twitter. So I will see you one way or the other on Thursday, whether it's a 15-minute video or whether it's more of a full-length video like this one right here. I'll let you guys decide there in the end. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.